Imagine looking at a financial screen and you're seeing two completely impossible things happening at the exact same time.
Right. It's totally jarring.
Yeah, because on your left, you're watching this massive technology company add the equivalent of like a small country's entire gross domestic product to its value in a single afternoon. Pure, unadulterated growth.
Just absolute rocket ship numbers.
Exactly. But then you look to your right, and the broader U.S. economy is flashing red, practically begging for a recession. I mean, government spending is dropping, consumers are pulling back. It looks like a glitch in the matrix.
It really is a fundamental disconnect. You have this extreme, highly concentrated heat in one very specific sector of the market, and it's colliding directly with this freezing macroeconomic front.
Which usually doesn't happen.
No, historically, those two environments simply do not coexist for long. Something has to give.
Well, welcome to today's deep dive. We are looking at a huge stack of data from a daily market briefing for a very specific pivotal day, which is Thursday, July 30, 2026.
A very wild day on Wall Street.
So wild. And our mission today is to decode it for you. We are going to figure out how a booming, absolute gold rush in artificial intelligence is just colliding head-on with a breaking U.S. economy.
Yeah, we really need to understand why certain AI stocks are just exploding while the everyday consumer economy seems to be hitting a massive print wall.
Right.
And, this day isn't just a random assortment of green and red arrows on a screen. It represents a massive stress test for the entire market.
A stress test on the AI narrative, basically.
Exactly. We are looking at hard data that forces us to question if the AI investment thesis can actually survive against the backdrop of a global economic reality that is, well, fundamentally slowing down.
Okay, let's unpack this, because to really understand the sheer magnitude of the market movements here, we have to start at the absolute peak of the mountain.
The mega caps.
The mega cap tech giants. These are the companies pouring tens of billions into AI infrastructure. And on July 30th, they were pulling in some mind-blowing rewards. Let's start with Microsoft.
Oh, Microsoft was the story of the day.
I mean, their stock jumped a staggering 15%, making it the most active stock of the entire day. For a company of Microsoft's sheer size, a 15% jump in a few hours is almost hard to wrap your head right around.
It is a tectonic shift in valuation. I mean, you don't see that with trillion-dollar companies.
Yeah.
But the underlying engine for that jump is what actually matters here.
Right. It wasn't just hype.
Exactly. It wasn't fueled by speculation. It was fueled by immense quantifiable growth in their Azure cloud computing platform and their Copilot AI integration. They showed the market hard, undeniable revenue numbers.
And Amazon rode that exact same wave. The briefing shows Amazon's stock soaring 9%. They posted a massive revenue beat, specifically driven by Amazon Web Services, or AWS.
Which is their main profit engine.
Right, and that specific cloud division expanded by an incredible 37% year over year. Think about how massive AWS already was in 2025, and then slap 37% growth on top of that massive base.
It's staggering. And maintaining that kind of percentage growth at that massive scale, well, it requires a torrential influx of enterprise spending.
Yeah, it means thousands of businesses, from banks to healthcare providers, they're all scaling up their digital footprints simultaneously. And they're locking themselves into Amazon's ecosystem to do it.
There is a really wild quirk in the data for this day, too, that we need to point out. The briefing notes that despite this massive 9% surge for Amazon during regular trading hours, both Amazon and Apple were actually set to report their official earnings after the bell.
Yeah, that part is fascinating.
The market didn't even wait for the final print from the CEO. Investors were using the options markets to price in these potential positive outcomes before the executives even got on the conference call.
Well, the options market is essentially a mechanism where investors can place leveraged bets on future price movements. So when you see a stock like Amazon surge nearly double digits before their actual numbers even drop, it tells you something important.
What's it telling us?
It tells you that institutional investors looked at Microsoft's massive Azure numbers and immediately extrapolated that success onto AWS.
Oh, right. Like, if Microsoft is winning, Amazon must be too. Exactly. The logic was, if Microsoft is selling this much cloud capacity to run AI models, Amazon absolutely must be experiencing the exact same demand.
But let me push back on that logic for a second. When you see AWS jumping 37% year over year, is this sustainable structural growth, or are we just looking at a one-time desperate panic buy by Fortune 500 corporations who are absolutely terrified of missing the AI boat.
That is the big fear.
Right, because it feels like every company practically has to pay rent to these new digital landlords, Microsoft and Amazon, just to keep their AI systems running.
What's fascinating here is that the earnings reports from this specific day help answer that exact question. I mean, for years, skeptics wondered if AI was just a hype cycle.
Just a shiny new toy.
Right, a theoretical concept that would just fizzle out once CFOs realized how expensive it was.
Yeah.
But these numbers confirm that AI investment has moved out of the experimental research budget and into core operational spending.
Okay, so it's permanent now?
Yes. The growth in Copilot and AWS proves that AI is generating massive tangible revenue. These companies are paying rent to the cloud providers because they are actively monetizing the tools they're building on those servers.
So they aren't just buying it to play around in a sandbox, they're buying it because their business now literally relies on it to function.
Exactly.
And that massive operational spending has immediate physical consequences. Microsoft and Amazon's booming cloud businesses, well, they don't run on abstract concepts. They run on physical servers, massive data centers, and highly specialized silicon.
Heavy, expensive metal.
Yeah. And that brings us perfectly to the incredible ripple effect we saw in the semiconductor sector.
Because when the digital landlords decide they need to build 10 new apartment buildings overnight, the suppliers of steel and concrete see their order books fill up instantly.
It's the classic selling pickaxes during a gold rush, but these pickaxes are incredibly complex GPUs. And the suppliers had an absolute field day. I mean, listen to this sweep across the semiconductor space.
It's a massive rally.
Huge. Suppliers like Lam Research skyrocketed 17%. Micron surged 15.7%. SKHY gained over 15%. And AMD jumped 12.7%.
And you have Corning and NVDA seeing substantial gains too.
Right. But we have to look at what these companies actually do, though. They don't just push out a software update to scale their business.
No, they manufacture the physical reality of the cloud.
Yeah.
Micron, for example, makes highly complex physical memory chips. You cannot simply, code more memory capacity.
They actually have to build it.
Right. It requires silicon, massive fabrication plants, and a lot of time. When AWS announces they're expanding by 37%, Micron gets a physical backlog of orders that practically guarantees their revenue for the next 2 years.
Wow.
The entire physical supply chain gets completely supercharged by the software demand.
Okay, wait. I'm confused, though. All these hardware guys are up over 15% because they think corporate spending on AI is going to be infinite. But the briefing mentions a massive red flag.
The OpenAI news.
Yes. OpenAI, literally the poster child for this whole movement, had to cut prices for 2 of their GPT 5.6 AI models on this exact same day.
Yeah, that was a huge moment.
And the reason given in the briefing is that OpenAI is facing growing pressure to cater to a more cost-sensitive customer base. So how are the chip makers ignoring this?
It's a great question.
I mean, if the premier AI maker is slashing prices because customers are getting stingy, doesn't that spell eventual disaster for the hardware guys who are banking on limitless budgets?
That is a brilliant tension to highlight, and it points to the painful maturation of the AI cycle.
Growing pains, basically.
Exactly. In the early stages of a technological shift, the infrastructure builders, like the chip makers and hardware suppliers, they profit immensely because the physical foundation simply must be laid, regardless of the end cost.
Right. You need the roads before you can drive the cars.
Precisely. But the software providers, like OpenAI, they sit on top of that foundation and have to eventually interface with the end consumer. And consumers have strict budget limits.
So the hardware guys get paid billions upfront by Microsoft to build the data center, while OpenAI has to figure out how to actually sell a subscription to, like, a small business owner who is watching every single penny.
That is the ecosystem bottleneck. OpenAI cutting prices for GPT 5.6 shows that the cost of inference, which is the actual compute power required to generate an answer, it simply has to come down for mass adoption to work.
It's becoming a commodity.
Right. It is entering a phase of commoditization.
Yeah.
But you are spot on to notice the threat. This cost sensitivity at the front end of the funnel will eventually cascade backward.
The domino effect.
Yes. If software providers cannot charge a premium to consumers, they will eventually stop paying a premium to the cloud providers, who will then, stop ordering as many chips from the hardware makers.
So OpenAI cutting prices shows the end consumer is starting to hit a wall. And we actually saw that exact same consumer wall completely derail some of the biggest tech stocks on the market today.
Oh, absolutely. The contrast was stark.
Yeah. Let's look at the companies that got crushed while the AI hardware guys were out popping champagne. Meta dropped 8%, completely missing their revenue guidance and suffering what the briefing calls a plunge in free cash flow.
A major stumble.
And Reddit sank 7%. They actually beat their estimates, but the market panicked over their warnings of, quote, choppy search referrals. It's like they're Olympic sprinters who tripped on their own shoelaces right before the finish line.
It is a brutal sorting mechanism. The market clearly differentiated between companies with guaranteed enterprise revenue and companies relying on cyclical consumer behavior.
But here's where it gets really interesting. Why is the market punishing Meta so harshly for a plunge in free cash flow? Let's define that quickly. Free cash flow is the actual money a company has left over after running the business and buying physical equipment.
Right.
Meta's cash flow plunged because they are spending billions buying the exact same NVDA chips that Microsoft is buying. They are in the exact same tech race.
Yep. Buying the same hardware.
So why are investors giving Microsoft a pass on spending tens of billions, but then they turn around and punish Meta with an 8% drop for doing the exact same thing?
If we connect this to the bigger picture, it comes down to the underlying business model. It's really the difference between building a toll road and building a billboard.
Okay, break that down for me.
Microsoft and Amazon are building toll roads. Azure and AWS operate on enterprise contracts. When they build a new data center, they already have Fortune 500 companies lined up to lease that compute power for years.
Guaranteed money.
Exactly. Companies must pay the toll to keep their businesses running. It is highly visible, highly reliable revenue.
So even in a recession, a bank isn't going to just turn off its cloud servers.
Right, they can't. Meta and Reddit, however, are fundamentally advertising businesses. They're building a billion-dollar billboard.
I see.
It might be the most technologically advanced, AI-powered billboard in human history, but they still rely entirely on consumer attention and ad revenue.
Which is super vulnerable.
Highly vulnerable. When Meta spends billions on AI infrastructure, they are trying to build better algorithms to serve ads. But if the economy slows down, an advertiser can and will pull their budget, regardless of how good Meta's AI is.
Oh. Yeah.
And with Reddit warning about choppy search referrals, it just shows extreme vulnerability to consumer platform dynamics. The market looks at Meta's massive spending and says, we simply aren't confident your advertising model will guarantee a return on this AI investment.
And that structural vulnerability wasn't just limited to advertising either. The briefing lists Rivian, the electric vehicle maker, as another major loser. They had to significantly reduce their 2026 spending plans.
Though narrowing their earnings guidance did slightly ease their forecasted losses, it's still a pullback.
Right. And then Jersey Mike's, the sandwich chain, they surprisingly ended up on the top losers list, dropping 6%.
Those two examples perfectly illustrate the mechanics of a struggling consumer economy. Rivian operates in a highly capital-intensive industry.
Yeah, making cars is not cheap.
No, they need cheap debt to build factories, and their customers need affordable auto loans to buy the cars. When interest rates are high, both sides of that equation break down.
And what about Jersey Mike's?
Jersey Mike's represents pure consumer discretionary spending. When everyday costs go up, skipping a $15 sandwich is the easiest way for a consumer to balance their household budget.
The consumer pulling back from sandwiches, cars, and ad budgets makes perfect sense when you look away from Silicon Valley and examine the broader economic data released on this day.
The macro picture.
Yeah, the U.S. macroeconomy is showing serious structural signs of fatigue. It's like watching a Ferrari, which is the tech stocks, driving across a bridge that is just structurally unsound.
That is a terrifying image, but very accurate. This is the freezing front we talked about at the beginning.
Exactly.
The economic data from July 30th provides a very sobering reality check for anyone assuming the AI boom will just carry the whole world forward indefinitely.
Let's look at the actual numbers that dropped, because they are grim. The U.S. economy's growth rate slowed to just 1.5% in the second quarter.
Very sluggish.
Yeah, well below expectations. And this was driven primarily by a decline in federal government spending and a drop in inventories. We are slowing to a crawl. But meanwhile, June core inflation remains stubbornly stuck at 3.3%.
Slowing economic growth combined with sticky, persistent inflation. That combination is notoriously difficult for policymakers to manage because it pulls their tools in completely opposite directions.
And the Federal Reserve's reaction to this mess, they held interest rates steady.
Which sent a massive signal.
It did. But here's the part of the briefing that really requires a deep dive. In response to the Fed holding rates, long-term Treasury yields actually jumped.
Yeah.
The briefing explicitly notes that investors are actively questioning the Fed chairman's credibility to act forcefully enough on inflation. But wait, I need you to explain this mechanism to me. If the economy is slowing down to 1.5% growth and government spending is dropping, shouldn't bond yields be going down? I mean, in a slowing economy, investors usually rush to the safety of bonds, which drives bond prices up and therefore yields down.
That is the standard playbook, yes.
Right. So why in the world are yields jumping if the economy is cooling off?
This raises an important question about how the bond market actually dictates the economy's speed limit.
Yeah.
You are completely correct that in a normal cooling economy, yields fall because growth is scarce and safety is prioritized.
Right. That's macro 101.
But you have to factor in that second number. Core inflation is stuck at 3.3%. That is significantly above the Fed's 2% target.
Okay.
When the Fed chose to hold short-term interest rates steady on this day, instead of hiking them to crush that inflation, the bond market basically interpreted it as cowardice.
Wow. So the bond market thinks the Fed is too scared of causing a recession to actually fight the inflation.
Yes, exactly. They are terrified of stagflation. That is that nightmare scenario where economic growth stagnates, but prices keep rising anyway.
The worst of both worlds.
Yes. So when long-term Treasury yields jump in a slowing economy, it means the bond vigilantes are staging a protest. They're looking at the Fed and saying, if you aren't going to raise short-term rates to kill this 3.3% inflation, then we demand a much higher yield on these 10-year and 30-year bonds just to protect our purchasing power.
Because the inflation is eating their returns.
Exactly. If inflation's going to eat away 3% of their money every year, they demand a yield high enough to cover that loss.
It's the bond market forcing the issue. By demanding higher yields, they are essentially raising the cost of borrowing for everyone, right? From Rivian trying to build a new factory to a family trying to get a mortgage, regardless of what the Fed actually does.
Yes, it's a total crisis of confidence in the central bank.
It really is. And when you layer the global economic trends mentioned in the briefing, like geopolitical uncertainties and trade tensions on top of that, you have a macroeconomic backdrop that is just fraught with systemic risk.
Absolutely. The jumping yields reflect a market that realizes the Fed's primary tool, which is interest rates, might actually be broken here.
Because they're trapped.
They are. They can't cut rates to help the 1.5% growth because it will cause inflation to explode. But they won't hike rates to kill inflation because it will completely crush the remaining growth.
Which perfectly explains the carnage we saw outside of the tech sector today. If you are a company like Jersey Mike's, you are caught right in the middle of those grinding gears.
Nowhere to hide.
Yeah, your customers are squeezed by inflation, your borrowing costs are dictated by a protesting bond market, and the overall economy is barely growing.
It's a very tough spot for standard businesses.
Okay, let's take a breath and synthesize everything we've covered today because the sheer volume of data is intense. We started by looking at the staggering, undeniable growth of the AI cloud titans.
The 15% jumps, the 37% AWS growth.
Exactly. We explored the mechanisms behind Microsoft and Amazon's revenue beats, showing how enterprise lock-in creates highly reliable toll roads for digital infrastructure.
Right, the guaranteed revenue.
And we saw how that AWS expansion physically cascades down the supply chain, creating massive guaranteed backlogs for semiconductor companies like Micron and Lam Research.
Building the physical cloud.
But then we found the friction. We analyzed how OpenAI lowering prices signals a cost-sensitive consumer base, which directly tied into the brutal punishment of ad-based platforms like Meta and Reddit.
Who saw their free cash flow plunge under the weight of those AI hardware costs.
Right. And finally, we zoomed out to the freezing macroeconomic front, a U.S. economy grinding down to 1.5% GDP growth, saddled with 3.3% inflation, and a bond market actively driving up yields in protest of the Federal Reserve's lack of credibility.
A lot of conflicting forces at play.
So, what does this all mean? When you look at the brilliant sun of AI and the dark storm clouds of the macroeconomy colliding on July 30, 2026, what is the ultimate takeaway for the listener?
The defining takeaway is that we are witnessing a profound tale of two economies operating in the exact same space. The immense wealth, efficiency, and productivity generated by the AI revolution are undeniably real.
The cloud numbers prove that.
The hard revenue numbers prove that, yes.
Okay.
But it leaves us with a critical, unresolved tension.
Which is?
Will the sheer deflationary force of this AI technological leap eventually create enough efficiency to insulate the stock market from the gravity of sluggish GDP growth and sticky inflation?
That's a huge if.
It is. Or is this massive capital rotation into AI hardware just a highly concentrated bubble that is utterly detached from the everyday reality of consumers and businesses who are currently drowning in rising costs?
That is the multi-trillion-dollar question you have to keep in mind when you look at your portfolio. Is the AI boom powerful enough to outrun a broken macro economy, or will the consumer wall eventually starve the cloud giants of their rent?
It's something we'll be watching very closely.
It is something you really have to weigh when you see these massive contradictory market movements flashing across your screen. Thank you so much for joining us on this deep dive into the numbers. Keep questioning the headlines you see, keep looking for the underlying mechanisms driving the market, and we'll be right here to help you unpack it all next time.